Welcome to video 5 of week 4. The question often asked by outsiders and non-finance specialists is, why does a company need to maximize return on equity? The first obvious answer is in order to satisfy the shareholders who brought some risky capital to the firm and to keep open the access to additional funds if the needs arise. How can we expect to raise additional funds from our shareholders if we do not provide them with a return rewarding the risk they have accepted to take when investing their money in our company? But there is another fundamental reason why we want to maximize ROE, return on equity. It is the way to maximize the self-sustainable rate of growth. What is SSG? What is the self-sustainable growth? It is the rate of growth that the company can maintain, the company can sustain, keeping the same financial structure, keeping the same mix of debt and equity. Let's take a very simple example by using company B that we described in video 3 this week. So remember company B. Company B had 100 of capital employed, financed by 50%, 50 of equity, and 50 of debt. This company had an after-tax ROCE of 12% and an after-tax ROE of 20%. You remember it was 10 of net profit out of the 50 of equity. Now, let's assume that this company has a dividend payout ratio. The dividend payout ratio, as the name is saying, is what is the proportion of profit that you are paying in dividend. You remember that the net profit was 10. That's where you get this 20%. Let's assume that the dividend payout ratio is, for example, 40%. Or if you prefer, some people will say that the retention rate, the proportion of profit that the company is keeping in the business is 60%. If you distribute 40 in dividend, you keep 60 in retained earnings. So what does it mean? It means that out of this 10 that the company has done, 40%, which is 4, are going to be paid in dividends to the shareholders. And that 6, the remaining, are going to be reinvested in the company. And where are you going to find them? You are going to find them here, increasing the equity by 6. Which means that the company could, if we assume that the management think that 50% debt, 50% equity is right, let's assume that for the moment, the company can increase the debt by 6 and keep the same mix of debt and equity. Before they had 50%, 50%, now they are 56, which is still 50-50. So you see that the capital employed in the company can increase by 12. In other words, the capital employed in the company increased by 12%. And if I make the assumption, last assumption for the moment, that my capital employed turnover, which remember we define as sales over capital employed. How much sales am I generating per dollar of capital employed? If I assume for the moment that this ratio is constant, which is not a very bad and stupid assumption because you don't change this ratio very quickly. You need some improvement in productivity. You all understand that if I'm able to increase my capital employed by 12%, and if the ratio remains constant, the sales could increase by 12%. This 12% that you have found in this very simple example of company B is the self-sustainable growth. It means that this company B can grow at 12%, keeping the same mix of debt and equity. But you see that if the company wants to grow at a higher rate than 12%, if the company wants to grow faster than 12%, the risk is that the company might be piling up debt until the whole thing becomes very dangerous and the company might be in trouble. So what is the formula of the self-sustainable growth? Self-sustainable growth is equal to the ROE, return on equity, multiplied by the retention rate. Or self-sustainable growth is equal to the return on equity multiplied by 1 minus the dividend payout ratio. In the example that we gave, self-sustainable growth is equal to ROE, 20%, multiplied by the profit retention rate, 60%, 0.6, which gives the 12% that we found earlier. Or self-sustainable growth is equal to ROE, 20%, multiplied by 1 minus the dividend payout ratio, 1 minus 40%, which gives, again, the 12%. What are the implications of this concept? If actual rate of growth is higher than the self-sustainable growth, if the company is growing faster than the self-sustainable growth, as you have seen, there is a risk of piling up debt. If, on the reverse, actual growth is less than the self-sustainable growth, if the rate at which the company is growing is lower than its self-sustainable growth, the risk, but it is a better risk, is to pile up cash. And by the way, it is a way to explain that today it's a little paradox in the tough economic situation. Many companies have been piling up cash, in particular in the US. And the reason is that companies have been doing quite well, performing well, they have cut their costs, their performance are good, their self-sustainable growth is rather high, but because of the economic crisis, they don't grow as much as they could, and therefore they are piling up cash. So self-sustainable growth represents a kind of financial constraint to growth. It's always possible to grow in a business. The only question is, at which cost? How many companies have experienced dramatic financial problems and ended up in bankruptcies because they have tried to grow at a higher rate than their self-sustainable growth? The misfit or the gap between the actual growth of a company and its self-sustainable growth has without any doubt been one of the main reasons of failures of so many entrepreneurs. How can you drive a car at 150 miles per hour if the engine is only designed to run at 80 miles per hour? If you forget the constraint, the engine will explode. The same will happen if the speed at which a company is growing is much higher than the speed allowed by the business and the financial characteristics of the company. How can we increase the self-sustainable growth to reduce this gap between actual growth and SSG? How to improve the efficiency of the engine of the car, to continue my initial comparison? The formula shows that improving the ROE and reducing the dividend distribution are the two main actions to undertake. Improving profitability, reducing the distribution of dividend. To make this recommendation even more operational, let's just replace ROE in the formula by the ROCE plus leverage factor that we saw a few videos ago. And therefore, we get this impressive formula, which says that SSG, self-employment growth, is ROCE plus ROCE minus interest rate multiplied by D over E. This is the formula of leverage multiplied by 1 minus D, where D is the rate of distribution of dividend. Why this complex and strange formula? Because it shows the levers on which you can play to improve the growth of the company. Improve the operating margin. Be more efficient by raising the capital employed turnover. This will improve your ROCE. Finance your debt at the best possible rate so that you increase the difference between ROCE and I. Increase, in reasonable limit, D over E ratio, the debt-equity ratio, and, if possible, reduce the dividend payout ratio. If this is not sufficient, only one solution: slow down the growth of the business, slow down the speed of the car, or find some equity investors. Find a second engine to assist, to help the first one. This concludes our presentation linking profitability and growth. On the long term, high profitability is required to feed a high rate of growth of any business. In the next video, video 6, we are going to apply these measures of returns and self-sustainable growth to our company Gremlin before concluding on the whole process of analyzing Gremlin's situation, providing an overall assessment, an overall diagnosis, and learning what really happened to this company. This next video will be a conclusion to the first part of our MOOC on financial analysis. And you'll find it in the conclusion module of your personal space. I remind you that you can subscribe to week 5 and assess your new abilities in financial analysis with a marked case study that will lead you to obtain your attestation of success to the MOOC. See you very soon.